Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about American Assets Trust, Inc. Annual Report. American Assets Trust, Inc. is a comprehensive real estate investment trust that offers a wide range of services and businesses. The company's primary focus is on acquiring, improving, developing, and managing high-quality properties in the United States' most dynamic markets. The company provides office space with approximately 4.3 million rentable square feet, making it one of the leading providers of commercial real estate. In addition to office spaces, American Assets Trust also offers retail services with around 2.4 million rentable square feet. This includes a mixed-use property that features a hotel and retail space. Furthermore, the company has expanded its portfolio to include multifamily units, with over 23,000 units available for rent. With its extensive experience in various markets, including Southern California, Northern California, Washington, Oregon, Texas, and Hawaii, American Assets Trust is well-positioned to cater to diverse customer needs. The decline of American Assets Trust, Inc. AAT, stock by 24.06% in the past year can be attributed to several key events and factors. One significant contributor was the company's weak fourth quarter and full-year 2025 financial results, which were reported in February 2026. The decrease in funds from operations, FFO, for Q4 2025 and the negative free cash flow available for distribution, FAD, coverage raised concerns about the dividend's safety and the company's financial health. Additionally, Morgan Stanley downgraded AAT stock from equal weight to underweight in January 2026, setting a price target of $17. This downgrade was based on concerns about flat FFO growth from 2026-2028, which underperforms the expected growth for comparable rates. Other factors cited by Morgan Stanley included challenges in West Coast office markets, significant upcoming lease expirations, difficulties in reducing leverage, and an elevated dividend payment ratio. These events collectively painted a challenging picture for American Assets Trust, Inc., leading to investor concerns about its financial performance, growth prospects, and dividend sustainability. As a result, the stock price experienced downward pressure, contributing to the substantial decline of 24.06% over the past year. The American Assets Trust, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. American Assets Trust, Inc. trades at a higher price-to-earnings ratio of 21 times, and a lower price-to-book ratio of 1.01 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 66% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 7.18%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for American Assets Trust, Inc. are closely tied to its diverse portfolio of real estate properties. The company's ability to acquire and manage a wide range of property types, including office buildings, retail centers, industrial parks, and multifamily apartments, is a key factor in driving revenue growth. The accumulated depreciation schedule, provided in the text, highlights the importance of accurately calculating the net book value of assets. This calculation can significantly impact the company's financial statements and inform investment decisions. Furthermore, the categorization of properties by type allows for analysis of exposure to different property types, enabling informed decision-making. Geographic diversification is also a crucial aspect of American Assets Trust's revenue growth strategy. The text lists locations of properties, including cities, states, and zip codes, providing valuable insights into the company's geographic spread. This information can be used to identify potential risks or opportunities and inform investment decisions. The acquisition dates for each property are also significant, as they enable calculation of holding periods and other financial metrics that impact tax obligations and depreciation calculations. By understanding these factors, investors and analysts can better assess American Assets Trust's revenue growth prospects and make informed decisions about the company's future performance. Net income and profit margins experienced significant fluctuations over the given period. Initially, net income decreased from $72,819,000 to $71,370,000 due to a decline in tourism and occupancy rates. This trend continued with a further decrease of $40 million to $167.1 million by the year ended December 31, 2025. However, there was an increase from -$60,522 to $71,370, indicating a shift towards profitability. The profit margins also underwent changes, with NOI margin decreasing from 398.1% to 372.6%. Conversely, net income margin increased from 25.1% to 26.8%, suggesting that the company's ability to generate profits improved despite the decline in NOI margin. FFO per diluted share/unit decreased from $2.58 to $2, while FFO attributable to common stock and units declined from $198,280 to $153,449. The reasons behind these changes were multifaceted. A decrease in rental revenue due to lower occupancy and lease termination fees contributed to the decline in net income. Additionally, an increase in expenses such as utilities, facilities services, repairs, and maintenance costs, as well as real estate taxes, further reduced profitability. The sale of Del Monte Center and acquisition of Genesee Park also had a significant impact on the company's financials. However, the issuance of restricted units contributed $303,648 to net income, while other comprehensive losses reduced net income by $4,093. The company's financial performance indicates a consistent generation of positive operating cash flow. According to various summaries, the company has sufficient working capital to meet its obligations and fund dividend payments. This suggests that the company's operations are producing more than enough cash to cover its expenses, resulting in a positive net operating cash flow. However, it is worth noting that there is one exception where the operating cash flow is decreasing over time. Despite this, the overall trend indicates that the company is generating sufficient operating cash flow to support its business activities and meet its financial obligations. The company's debt level has experienced a significant increase over the past year. According to various summaries, the total debt rose from $1.42 billion to $1.63 billion as of December 31, 2025, representing an increase of $190 million. This trend continued with further increases reported on subsequent pages, including a rise to $1.7 billion. The interest expenses also saw a notable increase, rising by $7.4 million from $43.8 million to $51.2 million as of December 31, 2025. However, there are conflicting reports regarding the changes in interest expenses across different pages, with some indicating a decrease and others showing an increase. Despite these discrepancies, it is clear that the company's debt level has increased significantly over the past year, while its interest expenses have also seen a notable rise. The performance of various segments and regions within a particular area has been analyzed. In terms of office segment performance, LPL Holdings, Inc., at La Jolla Commons and Google LLC at the Landmark at One Market have consistently contributed significantly to total office segment revenues over the past 3 years. Specifically, LPL Holdings, Inc., accounted for 13.1%, 12.3%, and 13.2% of total office segment revenues in 2025, 2024, and 2023 respectively, while Google LLC accounted for 13.3%, 12.3%, and 10.4% during the same period. On the other hand, there is no specific information provided regarding the performance of retail, multifamily, and mixed-use segments. However, it is worth noting that properties impacted by contamination or hazardous materials may pose potential issues for these regions. Furthermore, areas with high competition in the real estate market could also be a concern. Overall, while some office segments have performed well, there are still potential challenges to be addressed in other areas. Management at American Assets Trust, Inc., AAT, is focused on maintaining a stable outlook despite the challenges posed by rising interest rates and inflation. The company has implemented strategies to mitigate these risks, such as using derivative financial instruments to reduce its exposure to interest rate fluctuations. Management believes that contractual rent increases and expense escalations in leases will help offset inflationary pressures. AAT's management is also prioritizing debt reduction and maintaining a strong capital structure. While the company's significant debt obligations may impact its financial flexibility, management is working to balance liquidity needs with the desire to maintain a robust capital structure. Overall, AAT appears well-positioned to navigate the current economic landscape, thanks to its diverse portfolio of properties and proactive approach to managing risk. The company has made several strategic acquisitions to expand its portfolio and opportunities. On page 17, it is investing in mortgage receivables through originating mortgages and pursuing acquisition and development opportunities. Additionally, on page 19, it is acquiring properties or portfolios of properties through tax-deferred contribution transactions, as well as partnership interests in its operating partnership. The company has also invested in various renovation projects to enhance its existing assets. On page 58, it mentions renovations at Genesee Park, building out amenities and speculative suites at 1 Beach Street, and completing first-generation tenant improvements at La Jolla Commons III. Despite these acquisitions, the company has not made any divestitures as mentioned throughout the document. The company's financial history reveals a consistent trend of paying dividends to its shareholders. This practice has been documented across multiple pages, including page 32, page 35, page 46, page 64, page 65, and page 66. On the other hand, there is no clear evidence suggesting that the company has engaged in share buybacks. The closest reference to share repurchases appears on page 35, but it seems more likely to be related to dividends paid in stock rather than an actual share buyback. Concerns about inventory buildup and supply chain disruption are valid. The possibility of manufacturing facility shutdowns or distribution center disruptions can lead to delays in product delivery. This in turn may force tenants to reduce or delay product offerings, resulting in revenue loss and potential bankruptcy. Furthermore, temporary or long-term disruptions in the supply chain from local, national, and international suppliers can also cause significant issues for businesses. That concludes the financial summary for American Assets Trust, Inc. Feel free to comment below, and I will be happy to answer them when possible.